Good morning, everybody. Welcome to the Lock in Your Success Options Trading for Income Weekly Update for March 30th, 2015. Before we get going, we'd like to remind you that this presentation is for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that the risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. Also note that we are using hypothetical computer-simulated trades on the... I'm sorry, I'm just reading some comments here, so they're pretty funny. Please note that the presentation is hypothetical computer-simulated trades that are believed to be as accurately represented as possible. However, live results may vary. If you're watching this on YouTube or some other venue, come on over to our website, check out our M3, Bearish Butterfly, Rock, M21, and one-on-one coaching programs. Also, become part of our inner circle by joining our mailing list and get your free report, 7 Secrets to Becoming a Successful Trader, and sign up for this free weekly webinar. And stay tuned for our programs currently under development. Super Simple Spread Trades is due to be out next month. We're just simply waiting for SMB to get stuff posted. And as soon as it's done, this is going to be, it's 4 simple trades, including the V Condor, which we've been tracking for a couple of years now. And that'll be out starting in the next week or two. Also, we have our Advanced Position Management Seminar live coming May 18th and 19th, which is going to be a bunch of really advanced traders getting together here in Manchester, New Hampshire, and going over a 2-day, which is going to be about 16 hours of training. It's going to be a great presentation. I do have some spots still open for that, so if you're interested in coming to that, then please let me know, and we'll get you set up for that. Also, after that, we're going to have a recorded program, which is going to be available to the general public, and that can be purchased, obviously, and that'll be a great program as well. And from there, we're going to be looking at doing a book for the Trading Triangle program, as well as an online Trading Triangle course, so that we can actually accommodate more people with that, hopefully by the end of the year. So that's going to be a big undertaking on my part, and then we have some other neat stuff coming out as well. So just stay tuned for that stuff. Let's take a look at the markets and get Thinkorswim up here, and we'll take a look at the Russell 2000 in our charts. So last week, I was looking for the markets to probably go a bit higher. I was thinking with the Russell, it may come as high as 1280 and then have some sort of a reset to a support level. Obviously, the market never went up. Went relatively sideways Monday, sideways Tuesday, had a really nasty day on Wednesday, and now we've come down to basically our primary uptrend line. So this move here itself is not bearish at all. A very aggressive move, probably the biggest down move we had in quite some time, but still, as far as the total price movement here, very normal, still very bullish reaction here. If you look at the other indices, they did basically the same thing. We had a fairly, we dropped for the first couple of days on the SPX, but we basically came down to a trend line area, uptrend line area. So again, this is essentially, even though the market's been down, bullish price movement on the SPX. Looks like the NBX kind of pulled something. It's looking like it's pulling into more of a sideways move. But again, longer term, we're still bullish here. And the Dow is the same thing. We just simply came into a support level, which we're now bouncing. So from a purely technical standpoint, we are still bullish. We're still thinking the markets are going to go up, even though we had a significant down move. We just got a reset in the indices last week. Personally, I don't have that much conviction in it with what's going on as far as it's going to go up a whole lot. But to see a bounce here is expected. And again, from a pure technical standpoint, forgetting about opinions, this is very bullish market moves. So still looking for the markets to go up. We'll see what actually happens when things iron out for the week. So as far as our trades go, let's start with the April Bearish Butterfly. April Bearish Butterfly, as of last week on Monday, we were fully scaled in. We were at our 1220s, our 1240s, our 1260s. We're pushing right at the limits of a forced, not necessarily a forced roll here, but a force of starting to pull out of some of our 1220 butterflies. And like I said, we have a delta range limit of around 750 on this trade. We have a setting of around 750 on this trade. We have a delta theta ratio of 1.5 to 1. We're kind of borderline here, but realistically, we're still within guidelines. Tuesday, things didn't change. Wednesday, obviously, so there was no actually guidelines reason to actually do any sort of an adjustment to this. Therefore, there are no adjustments. Wednesday, we pulled back quite a bit, right? And now, boom, we're up a reasonable amount of money here. This is what we look like after the Wednesday move. And then Friday, we were 21 days to expiration, so we are looking at our reduced profit target numbers to get out of this. So around midday, a little bit before this, right, ended up pulling out of this trade here at midday on Friday. Like I said, it was 21 days to expiration, and we're getting some decent pricing. Didn't get that good a price. By the time we pulled out of this, we were up only, I think, about $7,200 on the way out. But if we take a look at our reports here, then we have 75.20 profit, which is, I believe, about 14, or actually it's just about 15% here. Return on our planned capital, and it was kind of a scary trade where we're holding a lot of delta. We're sitting right at our limits for a while, but it ended up being a nice trade where it pulled out. So a couple of comments here. The TOS platform is a setting for the volatility model called SMILE. Yes, more accurate than the individual volatility model and closer to the option view model. Yeah, the volatility SMILE setting in thinkorswim, I've talked to the thinkorswim people about using that setting. They say do not use it. Putting that aside, I will tell you that yes, the SMILE model is closer, generally closer to what option view is showing you for a T+0 line. However, the SMILE model also, at the same time, your profit and loss on your analyzed graph often is going to be way, way off from what it really is. So you might have a trade that's really up $1,000, and it might be showing that it's up, I don't know, $2,000, or it's down $1,000. So they're telling you not to use it. You can try it, you can play with that, but that is an option in thinkorswim. You just go to the volatility model in your settings, and you can change that. I assume you entered the 1260 due to the delta theta ratio issue. Why did you not close the 1220? No, I entered the 1260 because I hit my third add point. The initial butterfly on the bearish butterfly was at 1200. It was rolled to 1220 due to a delta theta ratio. It was added in the 1240 when we exceeded 1240, and added into the 1260 when we exceeded the 1260. So there was a delta theta issue during the trade, but there was no delta theta issue that caused a roll when I was 2/3 in. Can I show the T-log? Yeah, okay, well here's the T-log here. So that's easy enough. You can take a look at that. Where are the controls for the SMILE model? They're in one of the setup options that you have. So you just have to kind of hack around and find it. Like I said, I'm not how can I word this? I'm not condoning that you use option view with the SMILE settings. I would prefer that you not and use option view, but they are in the setup if you go looking for them. So I'm not going to go chasing them now. And I think that's it. All right, so let's go back to option view here. So that was a bearish butterfly. It ended up being a good trade. It was kind of iffy there for a while, but it ended up doing well. Let's go to the April M3 trade. Again, I'll go back to Monday, and I'll go before any adjustments here because I actually did make an upside adjustment on Monday. So let's just switch over to our April M3 trade. Here's what we're looking like. We were outside the tent. We're over minus 50 delta. Vega's fine, theta's fine, but delta's a little bit high for this particular trade. Now, one of the things I have going on with this is I'm near my maximum capital level because I'm like 49, almost 50,000. To correct this, I have the choice. I can sell some verticals. That's going to put me over my maximum capital level. I also have to keep in mind that I'm actually oversized, right? We started this with 12 butterflies instead of 10. That being the case, I just simply pulled off two of the butterflies, or two of the what are now broken wing condors. So I sold to 1170, 1220, 1240, 1270 condors to put us into this position to get us down to a more normal delta number. I don't know why it's showing me 66, but that brought us down to the delta number that we needed on Wednesday, at least at the time that I did it. On Wednesday we're here, and we're actually, you know what? Let's take a look at this here. Okay, yeah, so we're here, we're at the edge of the tent, so we're okay. Let's go back to Monday. Let me just re-describe here what's going on. So Monday, I allowed 67. I just want to be accurate with this. I allowed 67 because we're essentially at the edge of the tent. So I was thinking, if you remember right, we're like minus 100 in the tent, minus 50 outside the tent. In between, we're kind of between around minus 75 at the edge here. And that'll be a little bit, like I said, this isn't an exact number. It moves back and forth a little bit as you're looking at it. Around minus 65 is pretty good. I thought 85 was a little high, being this far out, especially being past. Doing this brought this down to 67. That's reasonable. That cut us down a reasonable amount. So that makes sense now to me. So sometimes I don't remember why I did certain things, but that's why we did that. So we reduced size just to cut our delta back. Here the market pulled back a little bit. Now we're essentially at the edge of the tent, and you know, minus 75 is okay there, and we're at minus 70, so that makes sense here. I just had a question. Would I consider rolling the 1170 up as a capital reduction technique? Let's see. Oops. Let me get back into the matrix. Yeah, I mean that's a legitimate. I mean that's certainly a capital reduction technique if you want to keep your size up to the 12 contracts. You could have rolled up your 1170s, which would have threw your delta a little negative, and then you could have made another adjustment to bring your delta back less negative again. But yeah, so that's certainly an option to do. But according to M3 guidelines, the straight-off guidelines, we're going to reduce the size here. We're not going to roll up the 1170s because that's not actually part of the M3 program to do that. So anyway, here's what we ended up there. Wednesday, obviously, we had that large down move. We ended up taking on too much positive delta here. Right here, it's only positive 59, but we're only down 22. By the time 330 came along, you know, we were down, I think, 26. Obviously, we were way over our delta number. So what I did is I took the 1220s as per guidelines. Again, we rolled back 20 points to 1200 and added in some verticals. We can show you that move here. So I added in 7 1200, 1220 verticals. We rolled back to 1200, added in 7, 1200, 1220, 3, 1200, 1230. Brought us still positive delta, but we backed ourselves up here, gave us some room to the downside in case the market continued down, right? Because we don't want to shift our delta from positive to negative when we do our rollback. On Thursday, I don't believe anything was needed on Thursday. No, our delta's a little bit higher, but this is what we look like on This is what it looked like on Thursday, and then Friday, of course, the market blasted off in the other direction a little bit, and I do not believe we had any adjustments on Friday either. So here's what we looked like as of Friday, pretty much flat delta, and here's the position here. And yes, we can show the T-log on the March M3, which is fairly easy. We started out with 12 contracts here. On 1220, we didn't do anything for quite a while. We started adding some verticals in. We did the rollback on last Wednesday, and we did, and that was about it. So nice and easy there. Do I typically add verticals back in? Okay, on the M3, do I typically add verticals back in when I roll back? Well, when I roll back, I want to maintain a positive delta. In other words, I had a positive delta end of day limit on this M3, a positive 50 delta on this particular trade. Obviously, I exceeded that by quite a bit, so we brought this back to 1200, if I brought this back to 1200 and just did 1200 butterflies, right, I do essentially a shift, I'm sorry, minus 10. I do a delta shift from, 2 positive to 2 negative, right? So I don't want that. This is not an M3 position, right? And I see this a lot with people who maybe roll back or make some sort of a down adjustment. They allow this to happen, and this is not within M3 concept. This is outside M3 concept. So to sort of fix that, we just add the verticals back in, and generally I'm going to go for around half my maximum positive delta, which is around plus 25. Plus 14 is fine. Let's see if we go back to Wednesday when this was done. Right, plus 14 is fine. I could have been a little bit more aggressive here and done another one, but we just want to be under positive 25, but definitely still positive. Oh yeah. So when I roll back, I don't do this as. In other words, I think the question is, when we do the actual rollback, do we roll back and buy the butterflies and then buy the verticals? No, I just know where I want to go to, and in other words, I'll be in this position, right? And I'll say, well, where do I want to go from here? And I'll decide what I want. And in that case, I decided I wanted those verticals, and then I'll just make up a series of moves to get me to where I want to be without actually ever doing any butterflies. That said, I can do butterflies. In other words, if I don't want to get confused, I know sometimes people get confused. I could simply roll back these butterflies and leave the verticals there for now. Right, so I could simply do this. Just ignore the fact I have verticals in there. And plus 10. Right, I could just do this rollback with just the butterflies and end up in a position like this, which technically, this is within N3 concept, by the way. I could leave this position. It's not orthodox, but if you're looking at the T plus 0 line, I have a nice flat T plus 0 line. I'm positive delta. Still, with the rollback, I could have just done something like that as well. I prefer, though, not to have the. I prefer my position to be more traditional, especially in the demonstration that we're doing now. Prefer it to be more traditional, so I would do that rollback, and then I could fix my vertical strikes to wherever I wanted them. So that's one way that I could do that. It involves double selling some options here, which I don't usually do. Usually I'm going to take some more complex, just do some more complex trades and end up in that position without actually rolling butterfly buys back. In other words, I can roll back this whole side down here. I can roll back, with a condor order, I can roll back my whole lower wing, and then using a series of condor orders and verticals, I can roll back my my upper wings to where I want them. So that's all good. If you're doing call vertical instead of puts, how do you know if you're getting the right price? All right, so yeah, so some people, to avoid this whole thing of being in a condor here, they're more comfortable doing butterflies here with call verticals here, and as you know, that's in the program. We show it that way, for a couple of reasons. I mean, at the time when the program was made, there were margining issues if you did everything in puts. But also for simplicity, we show it that way. If you're doing a put order, if I'm doing, let's delete a whole bunch of things here. Actually, all I want to show you is a vertical, so let me just delete some stuff. So if I'm actually doing just a vertical, if I'm doing call verticals, one of the things I want to keep in mind is your pricing if you're going to do an out-of-the-money put vertical. So if we're here and we're doing a 1220, 1240 put vertical, for example, or then essentially both options are out of the money. In this case, one of them's at the money, but let's just pretend they're both out of the money. That's going to have more accurate pricing than if you do a 1220, 1240 call vertical. So a lot of times the call vertical, if they're both in the money, especially if you're doing them way in the money, like if you're doing a 1150, 1170 and the market's way up here, typically your puts are going to be more accurately priced than your calls. So you want to make sure that you're using your put pricing to price your verticals. In other words, mid-price doesn't mean anything necessarily. So as far as those call verticals, because they're so far in the money and they have such wide bid-ask spreads on them, they're going to fill the call verticals no matter what they're priced at the same price relative to the put verticals. So if I have a $20 put vertical, that's worth $20, which means I'm getting a 710 credit to sell that. If I want to buy a call vertical, I should be getting a $12.90. It should cost me $12.90 debit, which is $20 minus 710, right? So that's basically how you do that. You just take the inverse price and you price it off whatever the puts are. So for example, if this came in and it told me it was going to cost me $14 to buy this, and I saw the put spreads at 710, then I would take 20 minus 710 and say, no, this should be costing me $12.90. I'd price out at $12.90 even though it said 14, and it would fill right around that area for pricing. So anyway, that's essentially how you would do that for pricing. If I'm not fully scaled into a bearish butterfly, I will start adding. I'll start adding butterflies to flatten out my delta if I'm not fully scaled in. So if I'm, say, 2/3 in and I have a negative delta of minus 500 and I only want a negative delta of 250, I'll scale in the last third to correct that. I like doing the complex combo because I don't like double buying and double selling options, right? So I could end up double buying if I do. In other words, I'm buying and selling options twice. I'll buy them to make one move, and then I sell them to make another move. I prefer not to do that. It's inefficient to do that. So I'd rather just do a complex order. It seems condors are hard to get filled. Yes, that was the question. I do. Back to my question here. Condors are fine to fill. They're going to fill them just about as easily. The reality is if you do two sets of verticals, sometimes you'll get a slightly better price, usually between 1 penny and 3 cents difference between what you can fill the two sets of verticals versus doing a condor order. But you're not taking on price risk. So the thing about doing verticals is you have to go positive delta, then negative delta when you do a vertical order. If you're going to kind of leg into an adjustment, you're taking on delta risk. If you want to do that, that's fine. But usually what you lose in trying to get the other side filled is cheaper. It's cheaper to just do the condor, even though it may cost you 1 to 3 cents more to do the condor. So they're perfectly fine to fill. I do hundreds of them at the same time sometimes. But you got to remember the thing is when you're doing the condor, sometimes the mid prices are way off, right? So there's a way that we come in here and determine accurate, where the mid price probably should be to get a more representative number of what they might fill at than what the mid price is showing us. And there's several ways to do that, but it's too complicated to explain here. All right, so now that now that it's 9:30 already, let's just move forward here. So the M3 trade got rolled back on Wednesday, and that was it. That was it. That was the end of the movements. So as of Friday, this trade is looking like this here, which is slightly profitable here at this point, and looking like this. So it's a good-looking trade. Depending on what the market does, if it screams to the upside, we're probably going to have a very small gain this month. If it stays back a little bit, then we can do pretty well. I do not use the spread feature in Option View. I do have students that use the spread feature in Option View. I have other ways to determine that. If you don't have Thinkorswim, though, it's easier probably to use the spread feature, in which case you can come in here and hit the spread and build your spread and get a theoretical price on it, which tends to be more accurate than mid-price. So I already showed the T-log for the April M3. I will just put up there quickly because we have to move on. There it is. Let me hit OK. Let's go to the rock trade because the rock trade ended up getting beat up here a little bit. So if you remember with the rock trade, we started out as a rock position, which was kind of unusual in recent history because we've had a lot of M3 entries because of the way they've been skewing the options. We ended up in a 1230, 1270 rock trade with some 1290 butterflies on. I don't think we did anything here on Monday. No, we didn't do anything until the 25th, which was in the market rollback. So Wednesday, we are obviously taking on way too much positive delta. If you take a look at Tuesday, everything's going fine, right? We're minus 159 delta. We look like this. Not a big deal. Now, the problem with this type of a position here is it acts like a condor, and as we know, condors, when you get a 30-point down move, is going to get hammered, and then this thing got beat up quite a bit. What we ended up doing here is, if we take a look here before adjustment time, and there was nothing intraday done here, but we're coming in, we're down 22 points. And we got a position that looks like this, right? Obviously taking on too much downside risk. Here we start widening this out to better protect against volatility, so we just widened out into a cat trade, which involves taking off these 1290s and rolling back to 1220. Pricing was a lot worse at 1530, so we ended up drawing down quite a bit more than what we had here. So about $4,500 drawdown, which is, what is it, about 10% or so. And it put us into cat position here. So now we are under different guidelines, but essentially if the market goes up, we go back into rock position. If the market comes down, we go back and down into M3R position. Or we may actually exit in this case because we're down more money than we'll be able to bring back with an M3R. So here's that trade. Not doing great as of right now, but we'll see if it comes back. Let's see, as of Friday, it came back a little bit. We're down about 3,700, and this is the position we're sitting in. So we'll see how that goes going forward. T-log for the rock trade, if we want to do that, is here. And that is it for adjustments, I think. So if we go to an April V Condor, I can just show you what we're doing at the end of the week. Very, very good V Condor environment, by the way, that we've had for a little while now. Here's what this position looks like as of the end of the day, Friday. No need to hit any adjustments at this point, so this is looking good. Let me close this out. And that's it for our April positions. We have a May Bearish Butterfly, so let's take a look at that. Obviously, that's doing fairly well. All right, we pulled back into the center of the position quite nicely. We're setting up about $2,300, only 1/3 entered, no adjustments there, obviously. The May M3 trade actually did get an adjustment on Wednesday, so let me just show that really quickly. Here's what we look like on the M3 trade in May, and this is, again, this is before the adjustment. It's at 1,500. As of right now, there's no reason to do anything. We're actually within Delta guidelines, but certainly by 3:30, we exceeded those, so we just did a rollback here. We rolled back 20 points to 1220, and I was actually able to just go into straight butterflies here and have my delta still be positive. Right, so we just rolled back from where we were into this position here. Here is the T-log move on that. I should probably mark this in. This trade is down slightly, but nothing to be concerned about. Like I said, as to be expected after a move like that. We're down about $800, and here's what we look like as of Friday. So still a nice looking position here. And then we have our May V Condor, which did not have any adjustments here either. So let's just take a look at that. This also is drawn down a little bit, mainly from a volatility type of issue. So here's what that trade looks like there. So that's everything that we have. That's all our open April positions and May positions. And I believe that we're all set from a question standpoint, which is good because I have to run and get to my next webinar. So I'd like to thank everybody for joining me today, and we'll see you next week.